M. Yeah, this is the fun one, isn't it? I like this one too. This is the fun one, Casey. Good day, everyone. Good day, Crypto Monkey. Hey, Jason. Hey, guys. Thank you, Chris. Appreciate it. Yes, you are. Tube famous. YouTube famous. Today's lesson is so complex, I need 2 notepads. Hello. Hello, hello. Thank you so much for joining. Very much appreciate all of your attendance. I can't wait for today's discussion in the dojo. Always enjoy the discussion that immediately follows these. I'm so glad to hear that everybody is getting lots of value out of the class. I promise you there is so much more to come. That's the exciting part about it all, is it doesn't end. It doesn't actually end at the end of the week here. This is just the start. This is how you begin your path. Because, you know, what follows from here is that we get to make strategies together. We get to spend time in the market together. That's next. That's what happens after this. Today is the Dark Arts Day, everybody's favorite class. It's everybody's favorite class because when you get to learn a little bit of the dark arts, it sort of peels back the curtain just a little bit. Yeah, that's exactly right. How great and safe it is. That's right. Yeah. That's what I'm going to teach you. I'm going to teach you how great and safe it is. No, I'm really going to break it down. That's the whole point, is I'm really going to break it down. I'm going to break it down to the underground, going to tear it apart, and I'm not going to make any excuses for it. I'm going to show you exactly what it is and exactly how it works. And I really hope that you take the lesson to heart, because it's a critical one. Like all the other lessons, it requires a progression. Like all the other lessons, it requires punching and kicking, blocking and dodging, jumping, and as I have taught you, doing it all while standing on a log in the river. This is just another strategy. This is just another way of managing your opportunities, of creating opportunities for yourself. And it's also a way of really destroying your financial opportunities if you choose to use it in the way that I suggest you don't. So I really suggest that, you take this seriously, because I don't want to see you lose money. This entire message has always been about profitability. It's always about, number one, plan for profitability. That's number one. Number two, plan the trade, trade the plan. It's always been about making sure that you have that plan. So go into this planning to be profitable. All right, everyone, let's get started. Good afternoon, everyone. I am Sensei Kevlar. Welcome to the penultimate lesson of the Boiler Room from my trading dojo. Prior to now, we have learned how to make ourselves profitable always. We've created strategies that relies on planning. Part of planning is having a plan to be profitable. What I'm going to show you today is about ways to be unprofitable. And I'm going to invite you to explore alternatives that will make you profitable in the correct way. But I really do ask that you take to heart what I'm about to tell you. What I'm about to explain to you is effectively a tool of financial destruction. And I urge of you to strongly consider, before you ever consider actually using this in any real circumstances with any real money, to first make a plan and see how that plan will make you lose money. And then think hard if that's still what you want to do. It starts when we understand that ultimately what we've been talking about these entire times is markets of value. Markets of value work when people agree that something has a value. The way that these markets work is, on one side, we have one person who's, wow, I don't even know how that happened, one person who's looking to buy something. We call this the ask book, and he's willing to pay a certain amount of money, let's say. And then there's, people who are willing to pay even more. Okay. On the other side, there are people looking to sell, and they're willing to let it go for a certain amount. And then there's people who want to, make even more off of their opportunity. That's basically how every order book looks with the price right here. On the other side of that, we have the bid order book. And it looks, basically identical, except that on this side we have people who want to buy cheaply. And when this order meets this order, in real time, a sale is made. This is the basic way all of these markets work, and what we can do is we can structure additional vehicles around these types of markets. If we know that somebody in the future is going to be paying a price for something, let's just make an example. Let's say that we have a farmer and he's got some cows. And in the future, he needs to do something like buy, he needs to get rid of some milk. Okay. Now, what happens is that because of seasonal changes, maybe the price of milk fluctuates, and his ability to sell the milk that his cows are going to make from now until the next 6 months is going to change, because this is all happening on an open market. The markets like the ones we've been looking at. And as we know, those markets go up and down. So when the farmer sees that the price of milk has gone up recently, and he wants to take advantage of it because he speculates that the price is going to go down, what he wants to do is he wants to sell into the bid book, right? That's how he does it, is he takes his ask and he says, okay, I'll agree to sell for 99. The problem occurs, though, that he hasn't actually made the milk yet. We're talking about ultimately milk that he is going to make over the next 6 months. But the price is high now. And so he wants to take advantage of the high price now. So what he does is he enters in to a contract with this buyer for milk. And he says, hey, you're willing to pay 99? Are you willing to pay 99 for the next 6 months for this much milk? If you want to buy this much milk, can I supply you, excuse me, can I supply you with this much fresh milk on an ongoing basis for the next 6 months at this price? Well, obviously, this guy thought that this was a good price. He was willing to buy. He was willing to bid at 99 price. And so he says, yes, I agree to buy X milk at $99 for the next, over the course of the next 6 months. Okay. At this point, what we've done is we've locked in an agreement. On this side, we've said, yes, the farmer has said, yes, I agree to sell you the milk at $99 over the next 6 months. Sell you X milk at $99 over the next 6 months. And he says, yes, I agree to buy X milk at $99 over the course of the next 6 months. Okay. What we have here is we have your basic contract. We have an agreement between two parties. On this side, we have a milk producer, milk seller, and what he's doing is he's going, I want to sell milk for $3.89 in the grocery. Therefore, I need to buy milk below 99 cents to be profitable. Okay, he's sitting here doing this calculation and saying I need to do this much, right? Meanwhile, over here, this guy's sitting here doing this calculation and he's saying I want to sell, right, I want to buy, I want to make milk for a cost of 30 cents. So I can sell it. So I can sell it for 99 cents. Right? So this is what he's picking up his grain for. This is what he's, this is what he's selling his milk for. This is what he's buying his milk for, the 99 cents to 99 cents. This is what he's getting on his milk. Everybody's making money. Somewhere along in here, the grain guy comes in, and then we repeat the process, in which the farmer agrees to be on the bid side, and the grain seller agrees to be on the ask side. Okay? But what we have here, this scenario right here, what we have is we have a scenario where the buyers and sellers of milk have created a contract. This contract is ultimately, interestingly enough, worth money. Why is it worth money? Well, it's worth, it's worth, what's it called? X milk at $0.99 over the next 6 months. And on this side, it's worth X dollars for X milk. So here we have X milk for X dollars, and here we have X dollars for X milk. What we're saying, though, is more importantly, what if the price of milk goes down? Okay. Remember, we're coming back here to an open market, and then this side fills up as well. Okay, this side fills up as well. Remember, we're coming over here to an open market, and this is how the order books look. Okay, well, the farmer has locked in a price for his milk of 99 cents. But at the moment, the best price that he can get is 96 cents. A difference of 3 cents. This contract that the farmer is holding is now worth a grand total of 3 cents. Because the difference of, because if you can just go and buy milk on the market for 99 cents, then a contract that lets you buy milk on the market for 99 cents, well, that's no different than going and buying milk on the market for 99 cents. But a contract that lets you buy milk on, that lets you sell milk on the market for 99 cents, and the best you can get is 96 cents, well, that's a difference of 3 cents. By selling this contract, by saying, hey, anybody want to sell some milk at 99 cents? Somebody can look at the market and say, oh, well, the best price I can get for selling milk is 96 cents. Right? Sorry, I can get rid of that right there because that's wrong. The best price I can get is 96 cents, right? I'm trying to get 97 and I can't get 96. You're telling me I can get 99? Well, sure. It's a difference of 3 cents, which means this contract is worth 3 cents for every X of milk. So let's say we agreed to 10,000 gallons of milk. 10,000 times 3. Well, that's $30,000. That's 30,000 cents, right? It keeps adding up. Whatever this is, as the price goes down, as this goes to 95 and 94, because this goes to 96 and 95. I've got these backwards, but I went in the wrong direction here. That's fine. The point is that I can, as these markets move, as the markets change their bid prices here, what happens is the difference in the market makes the difference of the contract. If the market continues to go down, and this contract continues to be worth close to $1, say the market goes all the way down to 50 cents, right? We're at we're trying to get 50 cents over here, and we're trying to get 50 or 51 over here. Well, at this point, according to this market, this contract is now worth close to 50 cents. because you can sell this contract to somebody who wants to sell milk, and they can sell it for 50 cents. What we're doing here is we're creating a new, what's called a derivative. This contract and this contract, the fact that we have a price for this contract, and this price is the derived value of what it is that we can presently get versus what it is that we're selling at, means that we can make a market for this as well. An example of this market is exactly what I'm talking about, where buyers and sellers do this. But this is not the only way that we can structure these types of contracts. We can structure these types of contracts to where we can say, rather than doing milk, I want to pay a price in the future for crypto. And the minute that one person agrees that I think the price of crypto is going to be higher in the future, and I think that the price of crypto is going to be lower at one point in the future, you can poof this contract into existence. As long as two people agree to that, and two people are willing to put up their money to support either side of this contract, then this contract can have value based upon the current price of the market. If the value is equal to the current price of the market, then the contract's not worth anything. But if on one side it goes up and the other side it goes down, then this person has made money because they can sell their contract at a premium, and this person has lost money because they now are holding a contract that no one would buy. Vice versa, let's say that this goes up to 120. Well, we're now 20 cents profitable on this side. We can now buy the asset at 99 instead of 120. Meaning this thing is 21 cents profitable for every contract you hold. Every contract you hold. And that's the point. By poofing these things into existence, what we can do is we can prop up a market on the fly. Rather than having an actual token that we're trading around in the blockchain, we can just make an agreement completely willy-nilly. This is called a future contract, because what we're saying is that I agree in the future to some price. I agree to sell at some price. I agree in the future to buy at some price. What we're talking about is we're talking about a market. A market with bid-ask protocol. It's the same thing. No tokens involved, contracts instead. They're called derivatives. And the way derivatives work is that the exchanges prop up these derivatives, they poof these contracts into an existence. They create a market and they say, okay, you want to buy? Okay, you want to sell? They call it short and long. Okay, you think it's going to go up? Okay, you think it's going to go down? Both of you now enter an agreement. That contract comes into an existence, and in order to get out of that contract, you have to sell it at in this case, a loss, or in this case, you get to sell it at a profit, because there's a market for it, and the market is based off the price of the asset that you can go and take to the market. Exchanges make a killing on this. Here's why. The way that these derivatives work is that they create these contracts and then they charge you for the right to do so. They create these contracts because two people agree to do it on a market. And then they charge you a fee on an ongoing rate. Well, you haven't actually done anything at this point. You haven't actually changed the game yet. All that you've done is you've paid for the right, you've paid a higher fee to use a derivative. And they call these packages fancy names. They call them options, and they call them future contracts, and they call them, you know, higher low contracts, and they call them binary options, and they call them the worst of all, the margins. The way a margin works is that what you're doing is you're creating a contract just like this to buy some coins really quick on a loan, and you're going to secure that loan with your own coins. But because you're buying more coins than what you have actually, you're entering those coins into the market, and then whatever loss or profit that makes you, you either accept or lose. And the way that this plays out is they make these products that look so tempting. I'm sure you're all familiar with Poloniex, and there are different names everywhere you go on different exchanges. You come over here and you look at the exchange and you see all these wonderful markets, and I've taught you how to trade them. I've taught you how to be effective in them. But then you come over here and they offer you a different product. It looks like the same product, but what they're really doing is they're offering you a derivative product, a derivative contract. The derivative contract states that you agree to take out a loan on more Bitcoin than you have in order to buy more Stellar than you have. Because the loss occurs on that additional amount, you also agree to take all of those losses on that additional amount, which means you now have less money to pay back that loan with at the end of that loan, which you are being charged by the minute for. If you lose all of your money, if all of that money becomes unavailable to pay back that loan, they'll just take all the money. They will take all your Bitcoin. So rather than just being able to exit this trade at a simple loss, you will exit this trade with no money left. Gone. Poof. Goodbye. Now, admittedly, if it does go up on you and you exit correctly, you will have made a lot more, because you will have used more money, you will have borrowed more money against a derivative contract, saying, I agree to pay it back in the future at this price, using these assets. And people see this, and they get excited, because it looks like what you can do is you can multiply your position. It looks like if you only have 1 Bitcoin, you can work like you have 25 Bitcoin, because they give you these 25x margins, 25 times margins. Here's the loan rate that they barely mention. This right here is 2% a day. If somebody came to you and said, I'm going to give you, tens of thousands of dollars on a loan, but I'm going to charge you 2% every single day. That's 10% every 10 days. That's 100%. You have to pay back 100% every 2 days. Every 100 days, rather. And this is how the exchanges make all their money, is off of products like this. There's a better option, though. There's a much better option than trying to leverage a derivative product. This is the derivative product I agree in the future to pay back this loan. I agree in the future to buy and sell these things on this side, future binary options, whatever you want to call it, margin trading, all of it. Stay away from it. There's a better option. The better option is right here. Instead of being on the side of the lending, you can be on the side of the lender. You can be doing the lending yourself. You come over here and you look at a volatile market like Stellar, and here is the rate that people are actually paying for their margins. When they take a margin loan, when they come over here and they buy or sell clams on a margin, not on the exchange, but on the margin, at Ripple, Stellar, Ethereum, whatever, on the margin, what they're doing is they're taking people's money who lended them. You're lending your Stellar, you're lending your XMR, you're lending your XRP, you're lending your ETH, and you're on the other side of that loan. This guy who is doing the buying and selling using the derivative product is taking your lent money in order to be doing the buying and selling. If you come over here and you look, you can see that there are loan offers available. And if you look very carefully, some of these rates are absolutely ridiculous. Absolutely insane. And if you saw just a minute ago, that was all the way at the top, and somebody's just order book stuffing this down in order to make it look like it's like the rates aren't available. But look at how it jumps up. What's happening is somebody's coming over here and they're buying and selling Stellar or XRP or whatever it is that we're on a margin. And they're paying some exorbitant loan rate. Well, could you be on the other side of that loan rate if you had a bunch of trophies? And here's where the strategy comes in. Let's say that you're working this, you're working this market, you're doing your straddles, you're doing your 50-50, you're doing your pivoting. You are really doubling up, tripling up, quadrupling up. You are really taking profits through all of here. You are really buying back through all of here. Because look at, you made a whole ton of profit because you really planned this out correctly all through in the beginning of September, and then you came to here and look at, it's October and we're making money. Now you've got a bunch of trophies from here. Well, some of them you could certainly schedule for this and make a ton of money with. But what's a better opportunity? Could you make 1% a day on some of these coins when these things go through the roof? Yeah, you could. Come over here, put your money into the lending side, and do secure lending. Because what happens is when these guys get stopped out, all of their funds go to paying you back. And you just get all your money back and they lose everything. Don't be on the margin side of things. Don't be on the option side of things. Don't be on the leveraged side of things. That's what it's called. Leverage. Because what you will find is that it's leverage against you in ways that you haven't been able to plan for before. It will cause problems that you will not like. You will lose all your money. You will not be able to plan. Look at the way that margins work. Investigate what a 25x multiplier would do. You want to know what a 25x multiplier would do on a motion like this one right here? Well, it's easy. It's easy to find out. You take your plan, exactly as it is right now, and you multiply your starting position by 25. You've now achieved exactly the same thing. You've now lost 25 as much going all the way down. And if you don't have the portfolio for that, then why would you do that? Why would you take that risk? Why would you set yourself up for that kind of failure? Plan the trade and trade the plan. If you can't handle a 25x here, well, don't come in and pay more for the opportunity to find out that you couldn't handle a 25x here. Don't pay more for the opportunity to find out that these things will take your money faster. Don't. It's important, because if you don't come in here and do your research first, if you don't plan for a 25x loss because you're doing a 25x margin, well, you may as well have just started with 25x more right here, not paid for the opportunity, and made all your money right here. You didn't need to pay anyone to 25x your starting position from the start. That's all you did. And it just gets bigger and bigger and bigger the more you go down. That's all you're doing. Be on the right side of this. Be on the safe side of this. Be on the smart side of this. Take your trophies and lend them. What happens is that people don't even know what they're doing. They're coming in here and they're saying, oh, 2% loan rate, no problem. And then they go, oh, I don't want to pay a 2% loan rate. And they put 0.1 in there. And then their order doesn't go through because there isn't enough volume at that market level to do any lending at that market level. So they put 0.2 in there, and now they're paying 0.2 a day. Well, could you be receiving 0.2 a day on your trophies? Could you be receiving 1% a day on your trophies when these markets go to town? Could you do that for 100 days and double your trophies for free? I'd like to find out. I'd like to see my trophies get doubled for free while I'm doing nothing without having to worry about it. These markets change constantly. Which one is working at any given time? Who knows? But diversification is a great strategy. Finally, don't chase these markets. Number one, automation will keep you sane. There's great opportunities out there. There's the GitHubs has a Polonix lending bot. GitHub.com Bitbot Factory Polonix lending bot. It's in the description of the live stream right now. It's also in the dojo. If you need help setting this up, find a coder. Find an automation specialist. There's lots of good options for doing this for free and making money for free. Now, here's the sad truth. These are still used widely. These are still pumped all the time. These are still sold as good options, as good alternatives. And those with big portfolios still can use them, certainly. When you have an unlimited amount of money and you can just keep throwing money at things, nobody can stop you. Nothing can stop you and nobody. So let's take a look at how people with really big portfolios actually use these. Here we are on Bitcoin US dollar tether. What a fantastic opportunity. Came right down in here, and man, if you were buying, would have come right back up in here and given you that opportunity to sell that right there. Very nice opportunity. Where are we going to go from here? I don't know, but I'm anxious to find out. What whales are doing, though, is they're scheduling their trades. They're coming up in here and they're saying, well, how high can we go? I'm going to schedule all the way out to 6,000. And then when I reach, 5,800 or something, I'm going to start selling. What happens when I reach 5,800 and I start selling? The market comes down again. Is that really what's happening here? Maybe. I'd like to call your attention to something else. If you come over here and you look at the BTC USDT, you will find that there are, over here on OKCoin, some other options. There's the dollar price index, which is a comparison of a bunch of different different exchanges. Okay, so if I just come in here and I click compare and I add that to my chart, the first thing that I'm going to do is it's going to screw up my scale. My scales are not going to be comparable. So what I need to do now, well, that's strange. What I need to do now is I need to come over and adjust the scale, which is not wanting me to. There we go. What I need to do now is I need to come over here and I need to adjust the scale. So I'm going to go to here and I'm going to say scale right. And what that'll do is that it will snap my two scales into proportion. The other thing that I'm going to do is I'm going to change my view of this. Instead of bars or candles, what I'm going to do is I'm going to do a line. And what I can see is that, Bittrex, for the most part, follows the index. The index is pretty highly correlated, especially recently. Okay? But then there's times when it wasn't. What about those times when it wasn't? What was going on there? Let's dig a little bit deeper. There's more to compare it to. There's BTC, USD, and then what we have is we have the derivatives. The derivatives are on OKCoin called future contracts, and future contracts are derivatives, which gives you 25x leverage or more. And every single week or every single 2 weeks or every 3 months, these contracts are settled against the index. That is to say that at that time, at closing time for the contract, the price will be closed at the price of the index. So if you have a loss at that time, you will take a loss at that time. And if you have a gain at that time, you will take a gain at that time. So let's take a look for 1 minute at the 3-month contracts. And again, what I need to do is I need to come in here and I need to go and change the scale so that the scale snaps into place. And then I need to change the style to be a line and change the line to be a different color so I can sort of compare and contrast them. Now, there were times, I'm just going to get rid of Bittrex for 1 second here, and I'm just going to look at these for 1 minute. There were times in the past when the 3-month contract price went above the index price. During those times, most famously, Bitcoin saw its biggest growth. Here they went below, but here they went above and above and above. Now, what happened here? Here they were definitely wrong, because we thought they were going above. The 3 month thought that we were going above, and here we definitely thought that we were going below. Had a big pull down against it. But what happened next? This divergence right here, that signaled this volatility right here. This divergence right here, that signaled this volatility right here. Every time in the past when we have gotten divergence above or below, like a MACD does, we get volatility. And when it snaps in a line, that's when we're not so volatile. Here, we got lots of divergence above, which gave us a signal that we were going to get lots of volatility following. Here, we got lots of divergence below, which gave us the signal that we have lots of volatility following. Well, look at what's happening. We set up for lots of divergence above, which gave us the signal that, once again, volatility is coming. If you're watching this carefully, you can see that there's a correlation. Divergence above, divergence below. Divergence above, we're going up. Divergence below, we're going down. The stronger the divergence, the stronger the signal. This is a weak signal. It's very, 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 very close. Very, 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 very close. And it's not telling us the correct thing. This is a strong signal. Divergence below. And look at what happens next. Then we go down. Incorporate these types of signals into your intelligence. This is whale watching. This is watching what the whales are actually doing. Why are the whales actually doing this? Come back to your derivatives. Your derivatives are giving you leverage. They're giving you 25x power on the motion of the market. Because you're able to willy-nilly create a contract that gives you 25x more coins than you had before, you're able to create 25 more times growth on this sale. What does that mean? It means that for the big boys who are doing this with the real money, who are really doing this and really do have unlimited amounts of cash to throw at things, they're making all of their money on this derivative market right here. See this nasty divergence? See how it signaled that we had volatility coming up? Make your own signals. Go back in the market and figure out what the whales are doing and when they're going to do it, because they tell you. They tell you right here that we've got divergence coming. Time to go down. They tell you right here that we've got divergence coming. Time to go down. They show you this signal over and over. Time to come down. When we snap in a line, it's time to go up again. Snapped into line, little bit of divergence. Lots of divergence above. Come back in the market. Find it again. Find it again. Find it here. And then we go down. Find it here, and then we go down. Find it here, and then we go down. What they're doing is they're pushing this market around. They're not really interested in the blue line. The blue line is just their help. Their blue line is what they're pushing around in order to make all of their money on the derivative market, because the derivative market is their 25x market. So they will willingly sacrifice this thing. They will willingly sacrifice this market. They will willingly go into the exchanges and sell at losses or buy at losses in order to make all their gains in the derivative market. Be careful. These are tricky signals. These are deceptive signals. These are deceptive markets. These are products that are meant to deceive you into getting rid of your money, into giving it all to the whales, into giving it all to the exchanges, into giving it all away. And you will wake up one day thinking that you have tripled your portfolio, and then the very next day, it'll all be gone. That isn't the way of the trader. The way of the trader is to be profitable always. They play these markets against each other to push out the little people and make all of their money on the derivative markets. Don't be the fool. Don't step into the trap. Follow their motions and plan for that volatility. Plan for that opportunity generation. Plan your trade and trade your plan. And maximize your opportunities. As long as you're always planning for profitability, this will never be a problem. This will never be a temptation. Because you know you could have just 25x'd your opportunity to begin with. It would be the same thing and you wouldn't have had to pay for it. Follow what the actual market makers are doing and follow why they're doing it. They're doing it because this is where they're making all of their money. And pushing this market around in order to ensure that that's the case. Plan the trade, trade the plan, incorporate this into your plan. I've shown you how to incorporate strategies or indicators into your strategies that give you signals. Now go build a signal based off the news. What's happening here? Go back in time and look. What's happening here? Go back in time and look. What's happening here? When this divergence is happening, was this a clue? What's happening here? What's happening here? What's happening here? Where were we back here? Where were we back here? Make your signal out of your indicators. Here's a great indicator. This is called whale watching. And whale watching is very much a part of the way of the trader. Thank you very much, everyone.